Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Ferrari stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Ferrari is an Italian luxury sports car manufacturer. The company is headquartered in Modena, Italy, and was founded in 1939. It went public in 2015 and currently trades on the New York Stock Exchange. The company built its first car in 1940 and produced its first Ferrari in 1947. The company has been known for its continued participation in racing, especially in Formula One, where it's the oldest and most successful racing team. Ferrari was rated the world's most powerful brand by Brand Finance. In June 2018, a 1963 250 GTO became the most expensive car in history, setting an all-time record at a price of $70 million. Ferrari is the 10th largest car manufacturer in the world by market cap. Let's get started with the model. This is a large cap company, 36 billion market cap. They're trading at $197 a share, and they have 185 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company does have positive free cash flow each year. It peaked in 2019 at 700 million. It dropped in 2020 to 150 million. Net income is the profit and loss on the income statement. That's pretty steady, from 600 million to 700 million. It peaked in 2018 at 900 million. Revenue is the sales for the company. That's also pretty steady. It peaked in 2019 at 4.5 billion. It dropped a little to 4.1 billion in 2020. This is the company's income statement. All the numbers in their financials are in euros, but I converted them to US dollars on my Excel spreadsheet. The top number is revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Example, cost of labor. The difference is their gross profit, and that's pretty steady. It did peak in 2019 at 2 billion. Now it's about 1.8 billion. Below that is operating expenses. An example of an operating expense is depreciation. Below that is operating income, and that was the lowest in 2020 due to their lower revenue. Below that is the interest they pay in their debt, and they paid the most interest in 2020, 49 million. Below that is other income and expenses. This is usually impairments or write-offs. Below that is pre-tax income, then their taxes, and the bottom line of the income statement is their net income. That was the highest in 2018. The only reason it was high in 2018 is because the taxes on the income statement were only 16 million. When you compare it to other years, 200 million, 175 million, lower taxes gives them higher net income. This is most likely a timing thing, with the difference the way the IRS and GAAP accounting calculates taxes. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generated from its operational business. I feel operating cash flow is a better indicator of a company's financial health than net income, because net income is your accounting profit and loss. It's not actual cash. Operating cash flow is net income converted to cash. And you can see they had $1.3 billion of operating cash flow in 2019. It did drop in 2020, but it's still a pretty strong number. Then you have capital expenditures, which are investments in property, plant, and equipment. If the company wants to buy a factory to start producing more cars, the cost of that factory goes into CapEx. Then that dollar amount is depreciated over time onto the income statement. Operating cash flow minus CapEx gives you your free cash flow. And they did have a low amount of free cash flow in 2020, 129 million. It was much higher in 2019. The company does pay a small dividend, but another way to reward shareholders is to buy back stock. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They bought back $100 million in 2018, then $400 million, then $129 million. They have over $200 million of dividend payments, so you can see their free cash flow wasn't enough to pay their dividends. That's why they issued a lot of debt in 2020, over $700 million. They added about $80 million of debt in 2019 and about another $80 million in 2018. Let's look at the capital structure. $2.1 billion of equity, $3.2 billion of debt. They're 40% equity, 60% debt. Their net debt is $1.6 billion, and their WACC is 8.76%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $19 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $17 billion. We divide that by 185 million shares. And we get a calculated stock price of $91. They're trading at $197, so they're trading at a 116% premium. It's a sell according to the model. Simply Wall Street is even lower than me. They're at $52 a share, so they're saying the stock is even more overvalued. In the past 3 months, 7 analysts valued this stock. The average price was $235. The low was $190, the high was $307. I even used a model that gave them the most future free cash flow growth, and I'm still coming up with a value a lot lower than what they're trading at. This just goes to show you how much a brand can influence the price. The brand of Ferrari is so strong that investors are willing to pay a premium to what the company's really worth. But as you know, the stock price is not based off of how much the company's worth. It's based off of how much an investor is willing to pay. And some people argue brand is the most important thing because it could take decades to build a brand. And some companies, after decades of being in business, still never have a brand that's known. It's a lot easier to get sales than to build a brand. To get sales, you just have to pump a lot of money to the company, take on debt, build factories. Anyone can do that, but not anyone can create a brand that's identified around the world, like Ferrari or Coca-Cola. This is the stock price the last 5 years. Even if you deduced the stock was overvalued at any point of time, you still could have made a lot of money. I wish I invested in Tesla a few years ago. Even though I still think it's overvalued, I could have made a ton of money, but I didn't invest. And this company pays an annual dividend, and they raise their dividend each year. It was 52 cents in 2016, now it's $1.23. They pay a 0.6% dividend yield. They pay out 42% of their net income and almost 200% of their free cash flow. They do pay a low dividend relative to the industry of 2%. They're in the bottom 25%. The bottom 25% of the market pays a 1.3% dividend yield. Here's a chart of the total car sales by the company by year. 3 cars in their first year. They broke through 10,000 cars in 2019. They could sell more cars, but they make their cars exclusive. When they come out with a new car, you have to sit on a waiting list. Even if you can afford the car, you have to wait for it. There's not many other cars like that. Owning a Ferrari is not just owning status, it's owning something that other people can't get. And GM had a down year in 2020, and they still sold more than 10,000 cars per day in 2020. They sold about 18,000 cars per day on average. Ferrari has the best margins by far. Their EBITDA margin is 32.5%, much higher than any other car company. Their beta is 0.92, so the stock moves with the market. The stock has gone up 52% in the past 52 weeks, while the S&P 500 went up 65%. And the stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. About 300,000 shares are traded each day on this stock. Of the 185 million shares outstanding, 164 million are on float, 39% are held by institutions, and about 7% of the shares on float are shorted. If you include dividends in the past year, this stock went up 42%, while the industry went up 450%. That's mainly due to Tesla, and the market went up 84%. In the past 3 years, this company went up 70%, the industry 360%, and the market 60%. In the past 5 years, the stock went up 400%. The industry went up 479% and the market 119%. Analysts are expecting their annual earnings to grow 17%, while the industry grows 37% and the market 19%. They're expecting Ferrari's revenue to grow 13%, the industry 23%, and the market only 10%. If you invested $10,000 into this company in 2015 when it IPO'd, you'd be at $37,000 today. That's a 28% annual return. The biggest shareholder is XR Asset Management at 24%. The family owns 10%, Bailey Gifford owns 6%, then T. Rowe Price, then BlackRock. Let's look at their financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 50.3, so investors are paying $50 for $1 of earnings. Price to sales is stock price over sales per share. They're at 8.8. Price to book is stock price over book value per share. They're at 17.1. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $2.1 billion of equity, $25 million of tangible equity, because they have 1.8 billion euros of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. ROE is net income over equity. They have a great ROE at 34%. Current ratio is current assets over current liabilities. They can easily cover their current liabilities with their current assets. Their current assets are 1.4 billion euros of cash and 1.2 billion of receivables. So the company is well capitalized. They didn't have much free cash flow, but they have $2.7 billion of working capital. So they have $2.6 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 11 car manufacturers, and Ferrari is right here. If they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better in every ratio except market cap. Their market cap is 36 billion compared to the average of 69 billion because Tesla is so high, it's dragging up the average. They do have a bad PE ratio, but the average in the industry is 58. So to summarize, I have them trading at a 116% premium, but if you buy this stock based off of their financials, you'll never buy the stock because it's always going to be overvalued like Tesla. The market moves on momentum, and people are willing to pay a premium for certain stocks like this. Plus, this company has such an iconic brand, they're still profitable, people still want their cars, so they're going to be around for a long time. I rank their free cash flows 5 out of 10, their revenue 7 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.